Investors turning their attention now to the next string of earnings out this week, and there are many. Joining me now at Post 9 to discuss is Kevin Simpson, Capital Wealth Planning. It's good to see you. That is the big story, of course, before we get to next week and the mega caps. What's on your mind this week of those reporting?
I mean, I think earnings are going to be the key because we have such a light economic calendar. Now, over the next 3 weeks, we've got massive things to take a look at because tons of earnings. We've got a jobs report. We get PMI. We also get a presidential election and a Fed meeting.
Oh, yeah, I heard about those things. What earnings are you focused on more than any other?
Very specifically this week, we've got Honeywell, Verizon, two names that are in our portfolio that had been kind of laggards for the past few years. I mean, fair to say Verizon hasn't lit the world on fire for the past decade, but it's done really well for the past, I would say, 12 to 18 months. Used to be that the stock would go down, the dividend would go up. But we're looking at Verizon, not expecting a killer quarter, a monster quarter. I wouldn't buy it into the print. But we think it's going to be good, and we're looking for guidance into next year. Same thing with Honeywell.
I just had somebody make the case for Honeywell at the top of our program.
Yeah, I like the name a lot. We think the aerospace part of it, that component is the most compelling. They're still a conglomerate, so you've got breakups there. You've got a little bit of a spin-off, which some analysts are saying is a negative. I think it's accretive to their bottom line. I like it. I wouldn't, again, be running into it, but I think the long-term prospects for Honeywell are fantastic.
Yeah, I mean, industrials, how do you see industrials as a group, since we're talking about that? Because that space has done quite well.
Yeah, it's been nice to see that breadth in the market, especially with industrials. We also own Caterpillar, as you know. That's been on fire as of late. And we removed Deere from the portfolio about 6 months ago. Still happy with that decision. But we're bullish on industrials. We like the Caterpillar play, and Honeywell should do well for it.
FCX this week, materials and other sectors. I mean, you go around and down the list of sectors, you're like, oh, record high, all-time high. And materials falls into that group.
We saw a pop with FCX because of the China play. You know, that's mostly a copper play, 90% copper, 10% gold. Incredible dividend growth. They really care about their shareholders, special dividends, share buybacks. I don't expect the copper to be a tomorrow story, but we do expect it to be a long-term thesis.
About the market in general. I mean, I think I asked Greenhouse at the top of the show whether we should expect some ramped up volatility over the next couple of weeks. I mean, the election feels like it's still, out of view a little bit because we got to get through mega cap earnings first, and that's going to take the tunnel vision of this market. But then the election looms on the other side.
Yeah, volatility should spike as we get closer. I mean, we know that from 16 and 20. But I think, Scott, that the volatility can continue into the end of the year because the uncertainty of what the Fed's going to do next year. Are they going to keep this cutting cycle at such a hefty pace, or are they going to take a pause? So with the volatility, we write a lot of covered calls. When there's heightened volatility, we lean into that call writing. We take advantage of the volatility also as a modest hedge. And I would encourage everyone to do the same thing. I mean, if you own stocks and you're a little bit nervous, covered call writing is a great way to maintain your position, assuming it doesn't go to the roof, generate a little bit of cash flow, and reduce your volatility.
What do you make of some of the calls that have been out there? They look at the valuation of the market now and suggest that means you're going to have pretty muted returns over the next handful of years, whether that's a few years or a longer period of time. There was the economist from Apollo, Torsten Sloke, was talking about that the other day. David Kostin, Goldman Sachs, is talking about, that sort of thing as well. Are you thinking about that?
No, I'm not quite as pessimistic. I think he had a 3% annualized return for 10 years. Now, we've had 2 lost decades, so it certainly can happen. And if you think about the covered call approach to investing, what better market than a range-bound market? And if you think about dividend growth, which is also our wheelhouse, we get 2 to 3% from dividends, 2 to 3% from option writing. Now you're getting 4 to 6% before we even get started. If he gives us a 3% lift, then we're at a 9% return. That's pretty much what the markets deliver.
But dividend growers have not done well with interest rates as high as they've been. So what happens now in an environment where we think rates are going to continue to come down?
No, we know rates are going to come down. I mean, it's a train. You just might not know when it's going to hit you, but you can see the light in the tunnel. And that's why our portfolio has done so well this year, just in anticipation of rate cuts. So when you're talking about dividends, whether it's high dividend zombie stocks or dividend growers, rate cuts are a tailwind. I mean, it's not necessarily feeding crack to a crack addict, but it helps.
Sure, but I mean, I did see one call today that says the 10-year is going to 5%. I don't know if it's going to happen or not. Nobody does. But I'm not sure how many had rates backing up to the degree they have at a time when the Fed did a jumbo rate cut.
Yeah, it's pretty crazy. And you can't have rates going up and stocks going up at the same time for too long. I don't think 5% is in the cards.
Well, you can for the right reasons, perhaps.
The economy's been strong.
The economy's good.
Yeah, and it is.